What's going on, YouTube? Welcome to the Credit Plug channel. So I wanted to sound the alarm on what's going on in the consumer finance space. So as a lot of you guys know, I work with a lot of different banks. I work with a lot of different credit card issuers. I'm actually able to see a lot of the back end data when it comes to loan conversion rates, credit card conversion rates, and conversion rates have tanked, basically hit the floor. And these are the lowest conversion rates, again, that I've seen just in my short time of working with a lot of different banks, working with a lot of different credit card issuers. And so I'm going to post up on the screen some recent statistics from a campaign that I did from one of my affiliates. And I'll put it right up here on the screen. So pretty much during the month of January, we had a campaign where there were 661 applications, of which 608 were declined, meaning that overall there was a 92% decline rate, right? So when you look at that, right, 661 applied and 608 got declined. Now, let me just explain how the conversion rates are sort of calculated, right? So at the top level, you have the number of clicks, then you have the number of applications. Sometimes there could be a layer added where it's applications, then pre-approvals. Sometimes if it's not a pre-approval, then it's just applications and approvals. And then sometimes what happens is people will get approved, but maybe they decide not to ultimately open up the credit card. And so, again, looking at these numbers right here, 661 applications, 608 decline, 92% decline rate. So 35 were approved, 17 ultimately were funded, and a total of 109,000 in cumulative credit limits between those 17 funded credit card accounts, right? And so just looking at that 92% decline rate. Now, back when I first started getting a lot of the back end data, I would say in 21 and 2020, the conversion rates were actually pretty high. When we look at a lot of the headwinds that are going on right now, you have consumer debt crossing over that $1 trillion mark. Recently, there was an uptick in mortgage delinquencies in the fourth quarter of 2023. We have record interest rates, right? Or not record interest rates, but relatively high interest rates, right? From my conversations with different banks and different bankers and underwriters is that a lot of consumers are just flat out tapped out. Either they've already maxed out their credit cards and they can't qualify for additional credit, which would make sense. And another thing to kind of just add context, my audience tends to lean more towards like the subprime type of credit consumer. So again, just by default of being subprime, usually your chances of getting approved are very much diminished, right? A lot of people are struggling to just repay the debt they've already accumulated. Lenders are also seeing an uptick in credit card delinquencies, right? So the number of credit cards that are more than 30 to 60 days past due. Now, what does this really tell us about what's going on in the economy right now and how the consumer is actually faring? And so based off some of the things that I've seen, it looks like, this is probably the worst I've actually witnessed, again, in my short time being in this space. And again, I see a lot of the back end data, a lot of the back end statistics. This is not just at the personal level, this is also at the business level too, where, the conversion rates are extremely low. Not as many people are able to qualify. And one of the things that knocks a lot of people out from qualifying is increased debt to income. Now, since prices have increased a lot, interest rates have increased. So let's say people who are putting different purchases on their credit cards and carrying a balance. Now, because prices have increased, they're spending more on the credit cards, and those purchases that are being carried over from month to month are subject to higher variable interest rates, which is increasing the debt that's being reported on a lot of credit reports. So when people do apply for these, new credit cards, their debt to income levels are too high to qualify, which could be a reason why we see, at least I'm seeing, a decrease in conversion. Now, this is something that I didn't really realize because for me personally, when I go through these different credit applications, mostly just for, sharing and doing videos and giving data points, I haven't gotten denied in quite some time. Now, again, I have very little debt. My utilization goes between, let's say, 0 to 1%, 800 credit scores. So when I'm going through these experiences, personally, I don't really have the context of what maybe some viewers or subscribers might be encountering. And I do see a lot of comments that, hey, I've been trying to apply for these different accounts and I just keep getting denied and denied. And so, one thing we do know is that during times like this, especially when default rates are up, interest rates are up, the bank is going to change their priorities in terms of the types of customers that they're willing to extend credit to, right? If you extend credit to subprime borrowers during high interest rate environments and when there's also a trend of increasing delinquencies, that can only spell disaster. So it would make sense that more, lower or subprime credit borrowers are having an extremely difficult time right now in terms of getting access to additional credit. But again, 92% decline rate, and this was in the month of January of 2024. So I just recently, got the statistics on, how this particular offer performed. And again, this is probably one of the worst performances that I've seen since I've been in this space, right? In 21 and in 2020, conversion rates were pretty high because people were able to get a lot of the stimulus money. They were able to pay down their debts. And so the debt to income levels were a lot lower. The credit scores actually increased between 2020 and 2021. So a lot of people had, higher credit scores, and interest rates, variable interest rates were actually lowered during that time period. But right now we're in a very interesting, crossroads where there's certain economic indicators that will say that the economy is doing well, right? The stock market is hitting all-time highs. The unemployment rate, which is highly manipulated, is still relatively low. But when we look at some of this consumer data, it's actually telling a vastly different story. And again, I don't have all the data available. I'm just sharing with you guys what I've seen recently, just from some of the different statistics from the campaigns that I'm running, and some of the different credit offers that some of our affiliate partners have. We're seeing very low conversion rates, especially on the consumer credit side. Now, another factor that can also be contributing to these lower conversion rates is that a lot of banks have increased their underwriting requirements, and they've also cracked down on a lot of fraud that has been escalating over the past couple of years. So, one particular partner, I know now they do like a biometric scan, they do identity verification, and they're actually able to auto decline a lot of applications that don't fit those identity verification measures. So again, it may not all be just credit or debt to income related, but I will speculate that that's probably the main culprit. But anyways, guys, let me know your comments and questions right down below. Do you think the economy is doing well? Do you think, consumers are in a good position right now? Because again, there's a lot of conflicting indicators out here, and I just wanted to share some of the insight that I have behind the scenes on, how consumers are faring in terms of credit card approvals and personal loan approvals. So let me know your comments and questions right down below. And until next time, take it easy, and we'll talk to you soon. Peace.